Hi, and welcome to this week's look at the major stories that have affected the market so far. And what are we going to take a look at today? Well, we're going to start with the dollar yen. That's reaching new highs of the year. Then we're going to take a look at the NASDAQ, and looks like that's officially entered a correction now. Then the price of gold seems to be stabilising near 5-month highs. And we're going to finish off with an equity like we normally do. And that's Google. And despite a good report, the share price crashed quite significantly. Okay, well, where to start? Well, the dollar yen is a new high of the year. Thursday, for the first time in 2023, the yen weakened to 150.7 yen to the US dollar. Now, since the start of autumn, the yen has weakened by 3.5%, which has pretty much continued its trend for this year. Now, why is this? Well, basically, it's a discrepancy or a difference between monetary policy in the two countries. The Fed, as we know, is pursuing a high rate policy. In fact, figures on Thursday about US GDP shows that it's growing 4.9% in annual terms. That was against a forecast of 4.5%. And last quarter, that was actually 2.4%. Now, that does sort of give the Fed a bit of a cushion to keep rates higher with the economy growing. Now, the Bank of Japan, on the other hand, continues its ultra-loose policy, interest rate below 0%. And if we take a look at some figures out of there, a Japanese CPI came in at 2.7%. It was expected at 2.5%, which it was 2.5% the previous month as well. So inflation possibly starting to raise its head in Japan, as we've seen across the rest of the globe. Now, the Bank of Japan does meet, that's next Tuesday, to discuss, much like a Fed meeting, their actions, and news coming out that could be quite important in terms of, are they going to try and support the yen, or are they going to try and combat inflation? Take a look at the chart. That shows that traders are perhaps concerned that the dollar-yen rate could drop as progress in the current trend seems to be slowing down. Now, it's worth noting the divergence of the MACD indicator. Take a look at that. And having reached the high of the year, the price is starting to show some bearish dynamics. The upper boundary of that channel seems a long way away at the moment, and we could in fact say unattainable. Now, bullish momentum this week could turn out to be a bit of a trap if the October 3rd high is broken. But back to next Tuesday, if the Bank of Japan do decide to take action to support the yen, or take some sort of change in attitude towards interest rates to combat inflation, that rate may well break down the current channel that's shown in blue. So plenty to keep your eyes open on, and don't forget your risk management techniques. Okay, now we're going to turn our attention towards the stock market and have a look at the NASDAQ index in particular. And it seems it's officially entered a correction. The decline to the current levels from the high of July the 19th have exceeded 10%. Now, that's generally considered to be the trigger for the start of a correction officially. According to statistics, it's the 70th correction since the index was created in February 71. This is all despite the positive report, in fact, from Microsoft, but a decline in Tesla and Google, which we'll mention in a little while, and the rise in yields on long-term bonds seem to have led the way down for the NASDAQ. So how strong could this correction be? Well, if we look at historically what's happened, and according to Dow Jones market data, for the last 20 corrections, it took the NASDAQ an average of 3 months to improve its performance. But after 1 year, the index was up an average of 14.4%. So it may not be terrible news in the long term. The chart shows the medium line of the downward channel, that's in red, is already exerting pressure as per the price action on the 24th of October. The price is now close to the lower boundary of the ascending channel, which we show in blue, which basically describes a prevailing bullish trend. Within that framework, the NAS price has increased more than 45% in less than 7 months, so a correction pretty much looks really appropriate. In the near future, we may witness formation of fluctuations caused by the support of the lower border of the blue channel and the current bearish sentiment, and growth may be resisted by the level of 14,460, which acted as support back in September. Now, next week we've got the Apple report coming out. That's going to be pretty impactful, I would suggest, on the index. And of course, we've got the ongoing geopolitical situation, and any news coming up there, perhaps of an escalation, may well have a significant and important impact. So again, don't forget your risk management techniques, particularly at times like these. Okay, we can take a look at gold now because the price of gold seems to be stabilising near the 5-month highs. We know gold often considered a safe haven asset. The price has been fluctuating around the $1,987, that's $1,987, where the July high formed roughly in that area. And in fact, gold is up about 9% in 3 weeks, and we can pretty much lay, if you like, the blame, is that the right word for that, on the fear of war. In 2023, gold has been a more profitable investment than the stock market. According to Dow Jones market data, as of Thursday's close, the S&P is up 7.8% since the 1st of January, whereas gold is up 9.2% at that same time. Certainly, I think gold traders are going to be focused on Friday's US core PCE figures that come out, which could cause some turbulence. As ever, inflation's still there, still in the news. So check those figures out. We could well see some price action after that. What does the chart show us? Well, the upside momentum within the ascending channel is fading around $1,978 as the price moves away from the upper boundary, and the median line shows some signs of resistance. Although it's worth noting the longer shadows at the lows of October the 24th to the 26th indicate the gold is actively being bought up on its declines, worth considering that. Now, technical support can be provided by the lower border of that channel, but also by the $1,958 level, which was previously resistance and now seems to be changing its role slightly. The proximity to that key psychological level of $2,000 could well be causing this bit of price stabilisation we're seeing at the moment. It's a real keen psychological level. However, any news from the Middle East on potential escalations of the situation over there could well push the price above that psychological level. As ever, keep your eyes open, look at the PCE figures, and obviously keep your eyes open on the news. Okay, and finally, we're going to turn our attention towards an individual stock itself, and the Google report crashes the stock price. Now, the share price was down 9.5% on Wednesday. That basically meant the value was down $166.64 billion of the parent company. That's the 5th largest capitalisation decline ever recorded. That's a significant fall. Now, this is despite the report coming out being better than expected. The earnings per share came in at $1.55. That was against a forecast of $1.45. Yeah, no, a pretty impressive increase. Gross income was $76.69 billion against a forecast of $75.95 billion. Again, a positive figure. So why the collapse? Well, amongst the reasons is that revenue from cloud-based services actually decreased against expectations. They came in at $8.41 billion, whereas the forecast was $8.6 billion. That seems to be one of the major points traders are holding on to. Although it's worth noting that's up 22% on the previous year's figure. Now, some US analysts are saying the reaction to this sort of cloud-based revenue decrease against expectations, let's make that clear, it's been overblown and is only temporary. What does technical analysis show us? Well, the bearish breakout of the contracting triangle, we can see that contracting triangle shown with the blue lines. Now, it's worth, if we estimate the width of the wedge at points A and B, approximately $126 minus $106, well, that gives us $20. Now, if we plot that from the breakout point C to get a guideline for where point D would be, so we take $134 less $20, that gives us an answer of $114. Pretty much a price aimed at the May gap zone. That could become significant as we move forwards. But to reach that level, the bears would need to overcome the support around the $126 mark, roughly where the price is at the moment, having found some support there on Wednesday. Further support comes from a line, you can see dotted in the chart, parallel to the upper boundary of the bearish wedge, as well as the $126 horizontal line, which has interacted with the price significantly in the past. So we can see $126 seeming to be a very important level for them. So good report. Despite that, a significant decrease, which obviously, as we mentioned earlier, hurt the NASDAQ. And we can't forget the political and geopolitical background, particularly in the US at the moment, could well help the bears in this situation. Any negative news could well drive the price further down. Well, we wish you luck with your trading in the week ahead. Bye for now.